A put option gives the buyer the right, but not the obligation, to sell an asset at a specified price, the strike price, before the option's expiration date. A call option gives the buyer the right, but not the obligation, to buy an asset at a specified price, the strike price, prior to its expiration date. Buyers of put options make money on the difference between the strike price minus the premium the buyer must pay to buy the option and the lower price of the asset. The maximum loss is the premium paid to buy it. Buyers of call options make money on the difference between the strike price plus the premium paid and however much the price of the asset has increased. The maximum loss is the premium paid to buy it. The premium, which is the cost to buy the right to make the trade. The expiration date, which is the last day that the right to exercise the options contract is valid. The strike price, which is the price the investor pays if they exercise the option to buy or sell. The amount, which is the number of options contracts that are either bought or sold. A call option gives you, the buyer, the right, but not the obligation, to buy the underlying asset at a specified strike price before its expiration date. You pay a premium to the seller of the option. This per contract cost is dependent on factors like the price of the underlying asset, the strike price and the time until the option's expiration date. For example, stock options are standardized at 100 shares per contract, so 3 contracts give you the option to buy 300 shares at a certain price by a certain date. Brokers may also add a fee for options trades on top of the contract premium. Let's say you believe that the price of XYZ stock will be higher in a year, but you are not certain if the price will drop before going higher. Currently, the price is $30 per share. Since you are unsure of its immediate path, you decide to buy a call option that expires a year from now and has a strike price of $32 per share. The premium, inclusive of broker fees, is 50 cents, which means that to buy one options contract, it will cost you $50, 0.50 times 100 shares. Let's say that at some point before expiration, XYZ trades at $35 per share, and you exercise your call option to buy XYZ at $32 per share. Your profit would be $35 minus $32 times 100 shares minus $50, or $250. A put option gives you as the buyer the right, but not the obligation, to sell an underlying asset at a specified strike price prior to the option's expiration date. Put options are like insurance policies. The buyer of a put option can sell an underlying asset at a higher price on a given date, even if the underlying asset is worth less than the strike price. Say you believe that the price of ABC stock will be lower in a year, but you are not sure if it will go higher before the predicted decline. Currently, the price is $20 per share. Since you are unsure of its immediate path, you decide to buy a put option that expires a year from now and has a strike price of $18 per share. The premium, inclusive of broker fees, is 45 cents, which means that it will cost you $45, 0.45 times 100 shares, to buy one options contract. So, you will stand to make a profit if the price of ABC is $17.54 or lower. If it doesn't trade at this price before it expires, then you will lose the premium, which is $45. Let's say that at some point before expiration, ABC trades at $15 per share and you exercise your put option to sell ABC at $18 per share. Your profit would be $18 minus $15 times 100 shares minus $45, or $255.